Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Thursday, July 30th, 2026, and we have a packed show. Microsoft's blockbuster quarter is lifting futures after yesterday's Fed-driven sell-off. PCE inflation and Q2 GDP both hit the tape this morning, and Amazon and Apple report after the bell tonight. A lot to get through. Lizzie, let's start with the big one. Microsoft surged nearly 9% pre-market after Azure crossed $100 billion in annual revenue. Does this print change the narrative on AI spending, or is it a one-stock story?
Morning, Robert. This print genuinely moves the needle on the AI narrative because Azure crossing $100 billion annually is hard proof that enterprise cloud demand is accelerating, and Microsoft's CFO went out of their way to reassure investors that CapEx is being deployed efficiently, which is exactly what the market needed to hear after months of skepticism around AI return on investment. That said, one strong quarter from one company doesn't resolve the broader debate, and the fact that Meta fell roughly 8 to 9% on the same night tells you the market is being very selective about who gets credit for AI spending right now.
So what's the key difference in how the market is treating Microsoft versus Meta?
The core difference is proof of monetization. Microsoft can point directly to Azure revenue growth as a tangible output of its AI infrastructure investment, whereas Meta's AI capex is still being treated as a cost center, with uncertain near-term payoff. And when Meta guided to even higher capital expenditure for the full year, investors essentially said they've seen enough promises and want to see the revenue line move first, which it hasn't done convincingly enough to justify the spending scale.
Tonight is the next big test. Amazon and Apple after the bell. What are traders specifically watching for?
For Amazon, it is squarely about AWS growth and the cloud margin trajectory. Because if AWS can deliver a number that rhymes with what Azure just did, that validates the entire AI infrastructure thesis for a second consecutive quarter and gives the Nasdaq something to build on. But any sign of margin compression from AI capex will be treated harshly given the current environment. For Apple, the focus shifts to iPhone demand signals and any commentary on tariff exposure, because with Brent crude near $92 and the consumer under pressure from higher for longer rates, the market wants reassurance that premium hardware demand is holding up globally.
The Philadelphia Semiconductor Index is down over 14% in 5 sessions, and the Nasdaq 100 is in correction territory. Samsung is warning the chip shortage runs through 2028. So why are US memory stocks like Micron still getting hammered?
The disconnect is a classic case of the market pricing, the near term over the long term. Samsung's warning about a prolonged chip shortage is a bullish multi-year signal, but right now traders are looking at Micron down 10% on Wednesday alone and seeing a company caught between slowing near-term demand visibility and the broader AI capex scrutiny hitting every chip name. And the 5-session losing streak in the Philadelphia Semiconductor Index reflects a repricing of growth assumptions across the whole sector, rather than a fundamental collapse in the underlying chip cycle. The SOX ETF is down about 25% from its 52-week high, but still up 54% year-to-date. And historically, 4 out of 6 comparable drawdowns recovered strongly, though buyers in prior cycles typically absorbed another 20% downside before any rebound materialized. So this is a setup that rewards patience over urgency.
The Zacks data shows 86.6% of S&P 500 reporters beating EPS estimates with earnings up 58% year over year. Yet tech stocks that beat are actually underperforming SPY by 3.3% on their earnings day. How do you trade that environment?
You trade it by focusing on what the guidance says rather than what the headline beat says, because the market is clearly telling you that backward-looking EPS beats are fully priced in, and what moves stocks from here is the forward narrative around margin sustainability and capex discipline. And you also pay attention to the sector rotation underway, because consumer staples names like AB InBev beat estimates with beer volumes up 1.1% year over year, supported by World Cup demand, and the stock still dropped, which fits the broader pattern of investors questioning pricing power durability in that space and rotating towards sectors where earnings revisions are actually moving higher, which right now includes energy, basic materials, and tech selectively.
Steve, we've got PCE inflation and Q2 GDP both out this morning. Given the Fed just held at 3.5 to 3.75% with that divided 9-3 vote and a hawkish tone from Chair Warsh yesterday, what are the key numbers traders need to watch?
Robert, today is genuinely one of the most data-heavy mornings of the quarter, and both releases carry outsized weight given where the Fed stands right now. On PCE, which is the Fed's preferred inflation gauge, traders need to watch core PCE closely because any reading that comes in above the prior month's pace will immediately reignite rate hike expectations, particularly with Chair Warsh already signaling openness to further tightening and 3 FOMC members voting for a hike at yesterday's meeting. on the Q2 GDP advance estimate, a number that surprises to the upside would complicate the Fed's path considerably by suggesting the economy can handle higher rates, while a soft print might give the more cautious FOMC members ammunition to push back against the hawks heading into September.
On jobless claims, the prior reading came in at 187,000 for the week of July 18th, well below the 212,000 forecast. Today's estimate for the July 25th week is back up to 200,000. Does a labour market this tight give the Fed any cover to hold, or does it actually raise hike risk?
A labour market printing initial claims at 187,000 2 weeks ago against a 212,000 forecast is historically very tight and gives the hawks on the FOMC a clear data point to argue the economy is not cooling fast enough to bring inflation back to target on its own. So paradoxically, a strong labor market actually raises the probability of a future hike rather than providing comfort for a prolonged hold. Today's consensus for the July 25th week is 200,000, which would represent a modest normalization, but still leave the labor market in very restrictive territory. And given that elevated energy prices from the Iran conflict are already feeding into inflation expectations, the combination of tight labor and sticky energy costs is precisely the environment where Warsh's hawkish signaling carries real weight into the September meeting.
Lizzie, US strikes on Iranian targets have pushed Brent crude toward $92 a barrel. How are traders positioning around oil, and which sectors are most exposed?
Energy is one of the clearest tactical trades in this environment. The geopolitical risk premium in crude has been building since the conflict escalated, and with Brent near $92 after rising sharply from around $72 when tensions began, the energy sector is seeing genuine fundamental support rather than speculative positioning alone, which is why energy earnings revisions are among the strongest of any sector heading into the second half. The sectors most exposed on the downside are airlines, consumer discretionary, and any industrial name with significant fuel cost exposure, while integrated energy majors and oil services companies are positioned as natural beneficiaries. And with ExxonMobil and Chevron reporting tomorrow, those results will be closely watched for how quickly higher crude prices are flowing through to margins.
Turning to crypto, Bitcoin is hovering around $64,500, but BTC has averaged an 11% drop in the 7 days following 8 of the last 9 FOMC decisions. Now that the Fed has already moved, are we in that post-FOMC sell the news window?
The historical pattern is hard to ignore. 8 out of 9 is a statistically significant signal, and with the Fed delivering a hold that came with a notably hawkish tone and 3 dissenting votes favouring a hike, the setup for a sell the news move is present, particularly since Bitcoin had been relatively stable heading into the decision, suggesting expectations were already partially priced in. Bitcoin trading around $64,500 with weak RSI readings and bearish retail sentiment suggests the path of least resistance remains downward in the near term, though the magnitude of any further drawdown will depend heavily on what PCE and GDP tell us this morning about the Fed's next likely move.
Ethereum is outperforming Bitcoin, up roughly 24% over the past month versus Bitcoin's 8%, and Morgan Stanley launched spot Ethereum and Solana ETFs this week. Is the institutional infrastructure quietly building a floor under ETH, or is the 35% year-to-date decline still the dominant story?
The Morgan Stanley launches of both the Ethereum Trust and the Solana Trust on NYSE Arca are significant from an infrastructure standpoint. Morgan Stanley's bank-affiliated distribution network through wealth advisors and E-Trade gives these products a reach that independent ETF managers don't have, and the fact that their Bitcoin Trust gathered over $400 million in its first 4 months demonstrates real client demand exists. That said, ETH is still down roughly 35% year-to-date and about 50% over the past year, and Solana is down around 41% year-to-date. So the institutional infrastructure narrative is a medium-term constructive story, rather than an immediate flaw. The dominant near-term driver remains macro sentiment, and a hot PCE print this morning would pressure both assets, regardless of how many new products get launched. On the adoption front, the BitGet Wallet asset-backed card launching this Saturday, August 1st, with cashback paid in Bitcoin, gold, or tokenized equities across 50-plus markets is a meaningful signal. Crypto card spending hitting $656 million monthly in May, and more than doubling year-over-year is real volume. And products that embed crypto into everyday consumer finance create persistent low-level demand that compounds over time.
The Clarity Act sits at just 38% passage odds ahead of the August recess. Tom Lee says it passes and Bitcoin goes to $68,000. How much of that is already priced in?
At 38% odds, the market is telling you the Clarity Act is not meaningfully priced into current crypto valuations. If it were, you'd expect to see more sustained institutional inflows rather than the cautious sideways action we've seen in Bitcoin. And that actually means there's asymmetric upside if the Senate surprises to the upside when Congress returns from recess in September. If the Senate punts, which is the base case, the trade is to watch whether the SEC moves forward with its own rulemaking framework, as Chair Atkins has signalled. That path is slower and less durable, but it still represents incremental clarity. And in a market starved for regulatory certainty, even incremental progress tends to move prices.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.